Next, we will learn about the different types of life insurance policies. Basically, there are 5 types of life insurance. The first one is term insurance, followed by whole life insurance, endowment insurance, annuities, and investment-linked plans. I think the main differences between these types of insurance policies are the time period of the policies or the maturity. The second one is in terms of the cash value available, and the third one is in terms of the premiums, so which is more expensive, which is the cheaper version. Okay, so we will go through these issues. The first type of life insurance is called term insurance, whereby this is the very basic of a life insurance policy. Term insurance is a temporary insurance or a fixed term insurance whereby the insured is covered for a fixed level of face amount for a specified period. Therefore, it means that the sum assured is fixed throughout the period, and so the period or the term is also fixed, right? It could be a 5-year term insurance policy or a 10-year term or a 20-year term insurance policy. Okay, so the death benefit equals to the face amount, and usually term insurance includes a guaranteed convertible clause in the policy, whereby the insured can convert this policy to a permanent plan or a whole life plan without any further evidence of insurability at the time of conversion. So say for example, somebody wish to take up an insurance policy, but he does not have enough or much budget. So term insurance policy is usually the cheapest form of life insurance. So say for example, this person takes up term insurance because he doesn't have the budget to go for something better. So he takes a term insurance for 5 years, and say after 3 years of the policy, his financial circumstances improves and he would like to convert the plan into a whole life policy which has cash value, then he or she can do so without showing any evidence of his insurability. Insurability meaning his condition of health. Okay, so because this term policy is already guaranteed, you take it up when you are still healthy and you declare your health condition. So to convert it to a different type of plan, like a whole life plan, is not a problem because of the clause of having a guaranteed convertible option. Okay, so term insurance, the very basic type of life insurance, is the cheapest form of life insurance. However, usually for term insurance, the insured cannot add on any riders, like a critical illness rider. Usually a term insurance is very plain. It just covers death and disability. The next type of insurance is called a whole life insurance. So this is a plan that provides protection for the entire lifetime of the insured, usually until he or she is 100 years old. However, I would like to stress that different insurance companies have different definitions of whole life insurance. I know for a fact that AIA, if I'm not mistaken, the tenure or the period of the life insurance is only up to 88 years old. They define whole life as being up to 88 years old. But other insurance companies could cover up to 100 years old. So we have to examine the contract. But usually 100 years old is the very maximum. So under whole life insurance policies, the policyholder will pay a certain amount of premiums, and there is no clear separation between the protection and savings element because it is bundled together in the cost of insurance. Okay, so unlike term insurance, whole life insurance death benefit will equal to the face amount or the sum assured at the inception of the policy plus whatever account value that is accumulated throughout the period. Okay, under whole life insurance policy, also there are three types. So the first one is a participating or a par policy, whereby the dividends are accrued to this policy from the life fund of the insurance company. Okay, so they still do, they will get some dividends that are accrued to the policy. Yeah, so it is a participating policy where the insurance company will pay out dividends. The other type of whole life policy is a non-participating or a non-par policy, whereby it does not participate in the dividends accrued in the life fund of the insurance company. So a whole life policy, although it may last throughout the lifetime up to 88 or 100 years old depending on the life insurance, but whole life insurance could be a non-par policy whereby it doesn't receive any cash value. The other type of whole life policy is a limited payment whole life policy, whereby the premiums are payable for a limited number of years, a much shorter period compared to paying premiums for the insured's lifetime, after which the policy becomes fully paid up. Okay, say for example, a person takes up a whole life policy insurance with company A, and by definition from this company, whole life means up to 88 years old. So say the person is only 30 years old at the time he wants to take up the policy. So he doesn't have to pay the premiums from 30 years old up to 88 years old. That is like 58 years of paying premium. So by taking the limited payment whole life policy, this the policyholder can choose to pay the premiums only up to a certain number of years. So he's 30, so say for example he only needs to pay the premium say for 15 to 20 years, and then where the policy will be fully paid up, and from say if he pays for 20 years, so he's 30 now, so he will pay up to the age of 50, and then he will still be covered from 50 to 88 years old, but without having to pay any premiums. Yeah, so here under a limited payment policy, premiums are payable only for a limited number of years. Yeah. Okay, so basically this is just to show you using some illustration about a whole life insurance, whereby the policyholder will pay a fixed premium to the insurance company, and the insurance company will allocate a portion of the premiums into a cash value account. Okay, so in this manner, the insurance company is able to pay dividends to the policyholder, and at the same time, upon death of the insured, the death benefit will be paid out to the family. So not only the death benefit or the sum assured or the face amount from the policy, but the family will also get the cash values upon death of the insured.